it's scary times for creators because of these Gen AI tools that are coming out. What do you think? Should creators be scared? Is this scary times?
I think things are changing really quickly, and I think that means that a lot of us, whether you're using a platform like Jimmy is, or you're building a platform like we do on our team, are having to think about how we need to evolve how we do what we do. The jobs are changing, and so I don't think that technology from the creator side is going to replace creativity. I think it's going to change who can be creative. I think it's going to change how people tell their stories. But at the end of the day, I think that people have creators and creatives, they have their taste, they have their processes, they have their judgments, they have their cultural commentary. And they're going to use those in different ways than before, because to produce a video isn't going to require what Jimmy has historically done with Mr. Beast and these huge sets and these amazing, elaborate production teams. It's going to be something that anybody can do with access to the right model.
Right. So on the one hand, it will make certain things easier. It will lower the bar for what it takes to, produce maybe something that feels highly produced. Does this create more creators? Does this create a upper crust of creators, because there's now so many more people who can do this?
I think it'll mean that today's creators, if they lean into the tools, or the ones who do, will be able to create more or even better content. But I think it also means that there are going to be people who couldn't be creators before who can now actually produce content of a certain quality or at a certain scale. But it also means there are going to be bad actors who try to leverage these technologies for nefarious purposes as well. So It's going to be, well, if you take a big step back, what the internet did, among other things, was allow almost anyone to become a publisher by reducing the cost of distributing content to essentially zero. And what some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
Yeah. So as someone who creates an algorithm intended to show people things that they want to see, do you anticipate, I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years? Are we going to be seeing a feed just full of AI stuff, or is there a human element that's going to be important here?
Well, today on the big platforms like Instagram and TikTok and Facebook and YouTube, I think there's actually a lot of hybrid content. And too often we talk about synthetic content and organic content and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
You mentioned there's a lot of potential for bad actors out there. We talked a few weeks ago, actually. Instagram announced 3 billion users, and we had a conversation then. And one of the things you said was, you rely, especially with AI, on a lot of self-reporting. People have to sort of let their audience know, I used AI for this. A lot of people don't do that. I'm curious what responsibility you think Instagram and Meta have versus how much of that is on the content creator themselves. Like, do you need to be identifying that something is AI and alerting the audience to it? Or is it all on the creator?
I think that we can do more to identify content that was created with AI. We actually, when we first did it, we were using the EXIF data, and a bunch of people got mad at us because Photoshop was exporting content and the AI was part of the flow, and then we were saying it was AI content, but the creator was like, this isn't AI content. But if you actually looked at how the flow was made, Photoshop.
Like they thought Photoshop was AI, or
They had
treating
used
it as
some
AI.
tool in Photoshop that triggered that.
Okay.
I think it was Photoshop, or maybe it was Premiere. I forget which app. So it's a sort of a delicate matter. For what it's worth, though, I think that trying to automatically label everything that was created in some part with AI, particularly when there's a lot of hybrid content where it's only part of the process, is a little bit of, it's not a fool's errand, but it's maybe the wrong focus. I think what's going to happen quickly is that you can still kind of tell when content was created by AI. Not always, but usually.
It's getting pretty good. It's harder.
It's getting harder, and I think pretty soon it'll be almost impossible.
Yeah.
And so I think what we need to do is, sure, we can work more on labeling, but we also need to provide more context for people to make more informed decisions about what to believe and to not. So, like the way you think about, literacy for like my kids are young, they're 9, 7, and 5. I need them to understand as they grow up and they get exposed to the internet that just because they're seeing a video of something doesn't mean it actually happened. And when I grew up and I saw a video, I could assume that was a capture of a moment that happened in the real world. And what they're going to need to do is they're going to need to think about who is saying it, who's sharing it in this case, and what are their incentives, and why might they be saying it. And there's going to be way more importance if you're going to make good decisions about what to trust and what to allow to inform your own opinions. We're going to have to shift emphasis away from the content itself, and not to ignore it, but just away from it, and put more on who's saying it and why they might be saying it.
Yeah, but you're doing that as an involved parent.
But as a platform, we can provide context too, right? And we do today, but we can do more. Like today, if you go to my profile, you can go to about this profile. You can see how long I've had this profile, what country I'm based in, how many times I've changed my username, a series of signals that you can use to decide how much you want to trust or not trust, or maybe it's not even about positive and negative. Maybe it's just about my political bias or my financial bias or any other kind of bias I might have.
It feels like it's evolving, obviously. The Instagram app is evolving as well. That was a big part of our last conversation. I think people still think of, I shouldn't say, I certainly still, part of me thinks of Instagram as this feed of beautiful curated photos and videos. Like that is maybe, it's certainly an older way of thinking about it. You're leaning very hard into this sort of newer version of Instagram, which is DMs, stories, reels. Walk us through a little bit about where your priorities are with Instagram right now. Like, is the traditional feed a thing of the past at this point?
It's certainly changing. All the growth in Instagram over the last 5 years or more has really come from DMs and reels and recommendations and stories. But we started as a feed of hypersaturated photos, glossy landscapes. You guys can all sort of picture the aesthetic. And that's just not how people use Instagram anymore. Our biggest risk is that the world evolves, we don't keep up, and we just become irrelevant. If we hadn't built DMs and stories and reels, you wouldn't be interviewing me on stage today. We wouldn't be relevant enough to show up at screen time. But moving it forward is also tricky. People get frustrated when they have an experience that they use for, call it half an hour a day, and then someone comes and changes it without asking them. So it's a balance, but we have to, because if we didn't, we would be in trouble. I mean, probably shouldn't do this because nobody can see the audience on camera, but how many of you use Instagram? It's okay if you don't. Raise your hand. Really high so I can see. Cool. How many of you, keep your hand up, have messaged someone in the last 2 days? Great. How many of you have posted a story in the last couple of days? All right, so maybe about half from it was like 80%. How many of you posted something to feed in the last 2 days?
For those watching, the number of hands is very minimal.
We have 7.
We went from like almost everybody to 7, yeah.
That's how Instagram is used. We connect with friends, we explore our interests, but we do so by seeing a reel and sending it to someone who we think might enjoy it, or responding to a story, or sharing a fleeting moment, or posting a note, actually, if you're younger than I am. It's posting to your feed is just not the primary way people express themselves.
Yeah, and that's evidenced by some of the stuff you're doing. So I want to get into this sort of test you're doing with Reels. You launch an iPad app, which people have been clamoring for a long time. The iPad app opens directly into Reels, so it doesn't open into the traditional feed. You're now kicked into this short-form video experience. You're testing that in India as well.
Yeah.
Is this the future? Like a year from now, are we all going to open up Instagram and instead of seeing that feed, are we just going to be kicked into what maybe feels like TikTok?
So so the test in India right now is an opt-in, and it opens. You have stories at the top still, but if you scroll down, it scrolls into Reels. But if you look at the Reels tab and the main feed tab, there are two primary differences. One is full screen media at a time, so you see one photo or video at a time, and that is the Reels tab, whereas feed is free scrolling. And then Reels has more videos and more recommendations, and feed has less. But they both have recommendations. They both have photos. They both have carousels, and they both have videos. It's just a balance. And so it's really a design difference and then a ranking difference. I think just swapping them doesn't really make sense, but I think that if a more immersive media is really driving all our growth, if we can figure out a way to transition the app to that being the experience that you swipe into, then that would probably be a good thing if we can make it happen. The question is, can we make it happen responsibly without pissing everybody off, without really hurting the business, because the monetization efficiency of video is lower. By finding the right balance, it's probably not ranked exactly as one is or the other is today. But that is definitely something I want to explore.
Yeah. I mean, from the outside, it's hard not to look at that and think TikTok. TikTok is driving this change for you. How much do you think about TikTok it's obviously a major competitor, but I'm wondering how much something like this is driven maybe by what you're seeing from competition.
I'm curious about this data. What is this data? Adults 18 to 34 average audience by hour. I don't know what that means. Cool. Definitely think about TikTok. Definitely think about YouTube. Definitely think about Snapchat. The immersive viewer predates TikTok, right? I think Kakao Stories pioneered the Stories format, which was an immersive viewer in Korea. It was popularized by Snapchat worldwide, so they should get a lot of credit for that. TikTok was applying that immersive viewer, that native first experience to short-form video, and they should get a lot of credit for that. And now, obviously, you've got YouTube Shorts, Instagram Reels, Facebook Reels, and the rest of it. We think a lot about TikTok because they are really good at what they do. They are better than I think the rest of the industry at this point at a couple things, at breaking new talent,
As in like identifying up-and-coming creators? Is that what you mean?
Yeah, so the way it works is when you're ranking content and you want to drive engagement, it's easier to drive engagement by showing content that lots of people like than to try and discover content that you might love that you didn't even know about yet, that might be from a really small name or a small creator. And that's called exploration-based ranking, when you try to literally almost test out things to see if they have legs, if there's an audience for them. They are really good at exploration-based ranking. We're closing that gap, but we're not all the way there yet. YouTube isn't actually great at that. YouTube is the best, I think, in the market at paying out creators through rev share and ads. That's because they're still mostly long form, and long form they've done a really good job with their their pre-rolls and their mid-rolls. But I think TikTok has been really culturally relevant because they've been able to break small names. They've been really timely, so trends happen really quickly. And they've just been reliably really fun and entertaining.
Yeah. There's obviously, I'm sure you've followed, there's a deal now, a proposed deal for TikTok to stay in the United States. It's kind of unique because it calls for the U.S. government to be somewhat involved in, if not managing, at least overseeing this new U.S. TikTok. Does this worry you at all, that the U.S. government might perhaps have an incentive for TikTok to do better than Instagram?
Should be careful with my words.
We're all friends here. You're welcome to say whatever you want.
What could go wrong?
Yeah.
I'll say a few things. One, I do think it's good that TikTok is still going to be in the U.S. It would certainly make our lives easier on the professional side to have less competition, but I think competition is fundamentally healthy. They've pushed us to do better work. I think it's good for the consumer, and it's good for competition. So I'm glad that they're still going to be around. On the specifics of the deal, it just seems all very hard to parse. It looks like more or less there's a bit of an ownership and a rev share change, but not an actual real change in how it's built. And in, because ByteDance and TikTok share code. Historically, most of the strongest ranking work has come out of China. I don't see anything that suggests that any of how it's actually built is going to meaningfully change.
Okay.
It just seems like an ownership stake and a rev share that's split between obviously ByteDance and the new owners here. But it's the same app, the same ranking system, the same creators, you're following the same people, it all sort of seamless. So it seems a little bit hard I'm not sure what to make of that. It doesn't seem like it's a major change. In terms of incentives, we always want to be considered. We always want to consider all the incentives of the most relevant parties involved. But I just want to stay focused on how do we make sure Instagram does a great job. Where they're better than us, how do we catch up? Where we think we've got a competitive advantage, how do we double down? And how do we keep moving forward and trying to make Instagram as valuable as possible for people? And then try not to get too sucked into the noise of the drama of the week.
We may be supporting your direct competitors, all that stuff.
We think about it, but we try to focus on what we can control and spend less time on what we cannot.
We'll only have a few more minutes. This always flies by.
It really does.
There was a report that you guys are building a TV app. Are you building a TV app? Let's make some news. This is it.
We're exploring TV. TV is an increasingly important surface. It's been very important for YouTube. Neil's talked about that publicly, the CEO there. It's been very important for TikTok. So we'd like to figure out how to make sure that we have we show up in a compelling way on all the relevant devices. So we're definitely exploring it, but nothing to announce today, unfortunately.
Why now, though? Why explore it now versus a few years ago? It's because, as you point out...
I wish we had explored it a few years ago.
Okay, why didn't you?
We've been busy. It seems like every year is a little bit more intense and a little bit more wild. I see that as a mistake, though, on my part, so I'll take ownership for that. We've been focusing a lot on ranking. We've been focusing a lot on evolving the experience forward. We've been focusing a lot on safety and parents. We've been focusing a lot on just compliance. Like I said, the biggest risk that we face is that the world changes too quickly. Not too quickly. It's going to change quickly, and we don't change quickly enough to adapt. And if behavior in the consumption of these platforms is moving to TV, then we need to move to TV too as a form factor. And if we're late, that's on us.
Right now,
it's on me.
It's on you. Right now, these videos.
With your deep voice, that sounded heavy.
It came off a little more dramatic than I intended. When I'm on Instagram looking at video, it's almost all vertical video. When I look at a TV, it's not. Through this exploration, have you thought about whether the stuff that's on Instagram today works on TV, or do you need to go out and, basically source new video that fits a TV screen?
I think the vertical content can work on TV because I think we can also show, we can show social context, we can show you the comments, we can show who else is watching. There's a bunch of things we can do with that space. We do still have horizontal content. We might need to lean into that too, but I'd rather first figure out how we can embrace the content ecosystem that already exists and the creatives that already exist on the platform. And if we have to expand, if it turns out we have to expand, then we'll certainly consider that then.
I was going to say, is there a world in which you go and, license more kickback content?
I don't like licensing content if I can avoid it. We pay for lots of licensing in general. For people are going to share stuff on our platform whether or not we want them to, music licenses, et cetera. We're always going to try to make sure we pay people for the rights, when we need to. But I'm not interested in trying to go get sports rights or exclusive entertainment rights because I'd much rather be the second screen. I'd much rather be where you talk about the game or the movie. I feel like connecting with your friends and short form video can be really symbiotic. And short form video and long form video can be really symbiotic. But long form video and connecting with your friends is really difficult to do in one place. If you're just watching a basketball game or a movie or an hour-long show, it's a lot of time that you're not actually talking to a friend, a lot of things you're not sending to friends or seeing that you might send to friends, et cetera. So I'd rather focus on user-generated content creators, AI, and less on premium, long-form, licensed content.
We've hit all the zeros. Very last, so that I don't get in trouble. What's your one tip? If you're a creator trying to hit it big on Instagram today, what's the one piece of advice you would give? And again, short, so that I don't get,
Yeah, you don't get in too much trouble?
Walked out. Yeah.
Now I can just filibuster and get
Yeah, exactly. Get me back.
I think it's really important to be intentional, specifically to articulate what you're trying to accomplish by using a platform like Instagram. So you might be trying to sell a product or raise awareness for a cause or build up demand for a brand. Just write down what you're trying to accomplish, and then also to be very clear about what is going to actually resonate with an audience, what's going to work on the platform. And you need to find a content strategy that is at the overlap of those two things. Because reach is great, but reach is a means to an end. So if you find content that is engaging, but it's not actually helping you move towards your goals, it's useless. And if you find content that is going to help you with your goals, but no one sees it, it's not going to be effective. It is much harder to find a content strategy that does both, but that's the job, that's the work. And that's going to require persistence, intentionality, and experimentation. But I really preach the overlap.
Credit has been fun, actually, this year for a while, and you're at the epicenter of one of the hottest markets, of course, private credit. I don't think people realize how fast you've grown in such a short amount of time, and even bigger goals ahead. Yeah. Let's start with the environment. This higher interest rate environment on the precipice of maybe a rate cut this year, how it impacts the way that you're thinking about investing.
I think one of the reasons why people are drawn to private credit, aside from the fact that it's had durable performance for a very long time and it's a growing market, is most private credit instruments are floating rate. So almost perversely, the higher rates go and the longer they stay high, the better the return performance, right? So clearly a lot of capital is being just drawn to the IRR opportunity. On the flip side, as rates stay high, it contracts the deal environment. And so there's always this tension or balance between wanting to see the deal machine turn on to drive velocity of capital versus benefiting from high rates. And we're kind of getting to a sweet spot right now. I think now that rates have stabilized and that cuts are on the horizon, we are seeing the pipeline pick up meaningfully, which means you should start to see more deals, more velocity, and even if the base rate comes down, it's still going to offer a pretty attractive rate.
Let's talk more about that. What was interesting is we spoke to the audience a little earlier. We put up a poll, and more than half of the audience believes that deals will meaningfully slow down. And so what are the signs of a pickup? How meaningful could that pickup be?
Well, half the people thought deals were going to slow.
Right.
Interesting. I think in the private markets, what really drives flow is the weight of capital, is the way that I think about it. I mean, most institutional equity that supports the private deal environment has a time limit on it, 3 to 5 years to invest. And obviously, you're always trying to find the right opportunity to invest where you can benefit from earnings or cash flow growth and capture multiple expansion. We're in this time now where people have been on the sidelines for quite some time. Investors are clamoring to get capital back. So that creates some tension for people to start to monetize performing companies. And as the dry powder ages, there's also a catalyst for deal opportunities. So I can only say in our pipelines, we're seeing a meaningful acceleration in deal flow. So I would actually take the other side of the
trade.
50%.
So what do you think about this condition private equity is in? There's been so much talk about this liquidity crunch investors are feeling. How much of that is being satisfied in the credit markets through kind of more esoteric financings we're seeing out there?
Yeah, it's real. I mean, this DPI issue is absolutely real. It has not resolved itself. If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle, what the prospects for your fundraising are based on returns, but everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising, and in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors. So secondaries, continuation funds, minority sales, private credit, refinancings, all of those things are on the table.
How exciting is, for you, the private equity versus private credit opportunity these days?
I don't... It's funny. I view it all as one spectrum, and I think this is why maybe private credit is growing and getting the attention that it is. Any asset that we invest in, whether it's a company or a piece of real estate, has an unlevered free cash flow associated with it. And as the markets evolve and we innovate, it's really just a question of where you want to attach to that asset. And in most markets, at the very early stage, sports being one, as Josh and Jason were just talking about, capital structures are pretty simplistic, right? Banks, equity, or banks, high net worth individuals. And as the markets grow and evolve, we all get quite creative and innovative of trying to figure out where we want to attach. And so, private credit, growth in private credit is in fact an extension of people's positive experience in private equity. We're able to go deeper into some of these assets at higher rates of return with more creative structures. But we have capped upside in a lot of these, right? So in some of our opportunistic credit mandates, we're actually creating debt-like instruments that have equity upside. But private equity is critically important for the investor community because it is the only place where you can go get 2 to 3 times your money. So private credit, durable, high current yield, performs through most market cycles, but at the end of the day, your return is going to be pretty range-bound, if not capped.
Now, it was interesting. A day ago, we had a boatload of debate on this stage about private credit risks, opportunities, cracks in the market. So let's hear it from you. Where do you believe cracks are, if there are any?
We're not seeing a lot of cracks. I've been in the private credit market for almost 30 years, and there's a constant and consistent narrative that there's risk being taken in private credit that somehow is going to topple the economy or create systemic issues. Back to my earlier comment, people need to appreciate most private credit instruments that we're all talking about are backed by some form of institutional equity ownership. And most private credit instruments are levered 50 to 60% of enterprise value. So if people are really anxious about losses industry-wide in private credit, you're blowing through trillions of dollars of value in the institutional private equity, real estate, and infrastructure market. So people need to zoom out and kind of understand again where these loans sit, who they're supporting, and the types of investments. That's one. Two, we have close to 4,000 middle market investments at Ares, and the credit performance has been incredibly strong. Default rates are low, interest coverage is healthy, EBITDA is growing in the low double-digit range. So yeah, we feel pretty good about it. I think it's all a little overblown, to be honest.
So another part of the market that I did not get to ask some of our guests about yesterday that you do very much operate in is real estate. Mm-hmm. How much stress is there still in that market right now?
Well, there's more stress there than there is in the corporate market. I think for maybe obvious reasons. One, the asset class runs more leveraged, so it's a little bit more rate sensitive. Two, the maturity wall issue in real estate is probably more acute than in corporate. The reason being there are just fewer levers to pull to effectively restructure or rehabilitate a piece of real estate. So when you think about maturity wall or even modestly underperforming corporate investments, you have levers to pull both on the balance sheet and the income statement to try to grow through it. You own a building, it's leased or it's not leased, the rent covers your debt service or it doesn't, and that's basically it. So the math of the asset class clearly sets up just for more acute stress. That said, when you put office in certain markets off to the side, we are still seeing pockets of strength in multifamily and industrial, which is where we're largely invested. So I think that story will still play out, but I don't think it's going to be a big systemic story. I think it's going to be one that kind of grinds its way out over time.
Whether it's the corporate market that might look to refinance or really restructure to kind of stave off the higher interest rate environment, or if it's real estate where you're seeing private market values really start to bottom in some people's perspective, how much money do you put to work? How big of an opportunity do you see?
As a private market investor, you can't try to perfectly time markets. That's the good news and the bad news, right? You have to be directionally accurate. We get the luxury of not having to pay attention to all of the headline, and volatility that can induce. But the best time to invest, both corporate and real assets, is when you think you're coming out of a cycle. So in real estate in particular, this is a great time to be forming capital, planting seeds because you want to get out ahead of it. And that's our experience, in multiple cycles. So, it's a pretty good deployment environment. Like I said, we are seeing the pipelines pick up, which is encouraging.
It's interesting. In addition to just deploying for your funds, we reported here at Bloomberg that you're also considering one of the largest private asset manager deals of all time, or at least we've seen in recent years in the real estate world. What can you say about your M&A ambitions of your own?
Well, not to speak about rumors specifically, we've been quite acquisitive, as you know. So if you look at our growth, 20% of our growth over time has come from some kind of M&A. I have a very strong view that these markets will continue to consolidate. And the reason that they're going to consolidate is from the manager's perspective, there's huge benefit to scale. Right? The larger we get, the more people we can have, the more people we have, the more deals we can do. The more deals we do, the more information we get. The better information we get, the better our investment performance, and then we get more AUM. And so there's this virtuous circle and cycle that scale creates in private markets, and people are beginning to see that. Investors are putting more of their dollars with fewer managers because they see that opportunity for outperformance, and they also see a huge efficiency. So most large institutional investors you talk to will tell you that they're shrinking their investor roster from, call it 100 to maybe 20 managers to try to drive efficiency and deeper partnership. And the markets are global and globalizing. So a lot of the things that we learned, let's say, over our 25 years here, we can now apply into developing markets like Europe or Asia that are earlier on in their maturity curve. So we will continue to be at the forefront on the consolidation. We want to be a consolidator, not a consolidatee. I think we have a really good track record of buying companies financially accretive, strategically accretive, and obviously driving culture, which I think is important. But we're not alone. So I would expect to see a lot of activity, particularly once you start to see rates come down and capital start to move.
Safe to say you'd be looking for large prey.
Well, it's all relative, right? So what was large 10 years ago isn't quite so large now. So, with a market cap that's $40 to $45 billion, we can actually do some pretty transformational things in large markets while making sure that we're managing the right risk.
So let's talk a little bit about another growth area for you, which is wealth. And there have been a lot of questions in this market. A lot of asset managers trying to make their private asset management business more amenable to the retail channel. How do you do that? You've seen some very high-profile examples of jitters in the market. Starwood, for example, limiting redemptions for investors. How do you navigate an environment
it's a good question, and maybe I'll just talk philosophically, and then we can talk specifically about how you do it. I'm a big believer in the importance of democratizing access to alternatives. For decades and decades, the world of alternatives was really only available to institutions. And so, yes, individuals were able to access it, but it was indirectly as a beneficiary in a pension fund. And so the opportunity for them with a sophisticated advisor and a sophisticated investment manager to get access to some of these outcomes, I think is critically important. So big believer that it needs to happen, and big believer that it will continue to grow just because I think the advisor community sees value in it. The difficulty is, which is where I think you're raising the question, is the retail investor doesn't always behave with the same level of patience and long-termism that the institutional investor does. And so a lot of these structures that we've created are designed to give adequate and appropriate liquidity, but not necessarily function with daily liquidity the way that the retail investor is used to accessing the markets. And we view that as a huge benefit, right? Because again, having managed, for example, ARCC, which is the largest traded BDC, sometimes the best time to be investing money, as we talked about coming out of a cycle, is when people are looking for liquidity. And so you're constantly going to be trying to balance your capital base and the deployment opportunity. And then lastly, I think the challenge that this market presents is in alternatives. Historically, we've invested out of drawdown funds where we can create alpha simply by not investing. So one of the ways that we outperform over time is to actually hold back, sit on cash, and then deploy when we see a better deployment opportunity. When you are managing continuously offered product, you get $1, you put $1 into the market, and that starts to function, in a way that is antithetical to the way that you generate alpha in private markets. So we've gone slowly in scaling those because we want to get the diversification that it provides. We want to provide the outcomes to the investor, but we don't want to inherit that, the weight of the money coming in when we don't think it's right to deploy. That said, we're one of the top fundraisers and managers in the space because most of the large wirehouse platforms, RIAs, and IBDs want access to top quality alternative product. We have a wealth distribution capability with about 150 people around the globe. We have 8 products in the channel, all of which are scaling quite nicely. And so now, similar to an institutional investor, a retail investor can largely access our real estate, private equity, private credit, and infrastructure capability in some format in the non-traded market as well.
We are going to switch to sports, too.
Okay.
Because that's the fun stuff. It's also the place we're getting a lot of questions from the audience as well. And, of course, that's both through Ares' own involvement. And, of course, you are a part owner of the Baltimore Orioles. Mm-hmm. And so if you think about sports, how much investor interest can you draw? We have reported that you are one of the firms close to the NFL process as well. What does this mean for the amount of money that can come into different leagues?
Well, I hinted at it earlier, so maybe I'll repeat it. That this is a new asset class, right? So if you think about the structure of the sports landscape, just teams and leagues, putting aside stadium redevelopment projects and media rights securitizations and youth sports and all the things that, right? So this is a huge ecosystem of assets. But if you just go to the team and league level, up until COVID, the structure of the market was pretty simplistic. It was bank capital and rich people. And those two sources of capital were able to support a pretty compelling, growth in value in these assets for a very long time. When COVID hit, two things happened. Number one, you had a lot of owners of teams that had generational wealth that got created through the ownership that were asset rich and cash poor, and all of a sudden had a business model where they were struggling to actually support the asset. So that caused a lot of the team owners and leagues to start thinking about the importance of some other form of creative capital to come into the market. And that really is when we leaned in at Ares to start building in earnest what is now a pretty large sports investment franchise. And then the second thing is, coming out of COVID, I think everybody relearned how important live content is and how much we all enjoy going to sporting events and how much time we spend watching on TV. And so you saw this reacceleration in the value of global media rights for sports teams and sports leagues, which started to accelerate values again. So now you had a secondary problem, which was, now that we've kind of healed through COVID, in a world where you're trying to grow your franchise value 10 to 15% per year compounding, how do I support that? There's just not enough bank capital or high net worth individuals that love sport that can actually drive those values. So a lot of the leagues and teams are now starting to think about institutional capital as a critical component of the growth in these franchises. If you just think about you mentioned the NFL and not to hone in on that, but if you just take the equity value of the teams in those leagues, you're talking tens and tens of billions of dollars of investable opportunity that didn't exist before.
What's the NFL math?
Well, take your number of teams and multiply it by 5. So there's $100+ billion of franchise value that needs to get supported by some form of institutional capital over time. Baseball, you have 30 teams with probably an average franchise value, in the mid 2s. So that's $70 billion of asset value, and so on and so forth. And so each league is going to be different in terms of where they are in their media positioning, what kind of flexibility they're willing to accept or not accept. But institutional capital is going to be a critical component in continuing to evolve the.
You think about the Mark Lazard comment last year about the NBA. Valuations feel toppy, so I'm getting into pickleball instead. How do you feel about that? Are valuations getting toppy? Do you look for places where maybe there's more of a runway, like women's sports?
Well, we've been a big supporter of women's sports. We helped to launch a professional women's volleyball league through our sports franchise. We've been supporting the growth in women's soccer. I don't think you have to choose one. I don't think that valuations are getting toppy. The reason that folks are drawn to investing, at least in the large leagues, is scarcity value. There's a complete lack of correlation from anything else that you can invest in. So you can go back 15, 20 years and map the growth in sports franchise values against traded fixed income, public equities, private equity. Zero correlation for the most part. So that's of significant value. So I don't think you have to choose. The upstart leagues or the challenger leagues or some of the things like youth sports, women's sports, pickleball, cornhole. There's an endless set of things that you can invest in, and they all have value, right? Like in anything we do, they're going to be on a different growth trajectory with a different set of risks and a different set of opportunities. But I think it's all getting to the same point, which is we spend a lot of time globally consuming sports content, whether it's pickleball or the NFL. Like, that is a big part of the human experience. We all emotionally attach to it. Most people are passionate about some part of the sports ecosystem. And now the opportunity to actually tap into that through investment is going to be another, accelerant, just because people want to be a part of it.
Do you need something?
Ooh. Peekaboo.
Are you okay?
God damn.
Like, seriously?
Yeah, I'm okay now. I don't usually do this to girls. God, come on, bro, get it together. I think you downright beautiful. You getting me all feely and stuff. Getting splinters for you, baby girl. So like, I don't know. Hypothetically, if like you were naked, I was naked, and we was just like super horny or whatever, like, would you be down to kiss?
No. Just leave me alone.
What?
Can you just let me be on my phone?
You gonna be on your phone without me? Pouty little baby over here. If you want me to stay, just say leave. It's fucking illegal how cute you is. I never said that before.
Do you know what no means?
Hypothetically, if we were like the only two people in this world and we had to like have sex to like repopulate the earth, would you be down to like have sex with me?
Ew. Oh my god.
If I was the last person on earth, girl.
I'd literally let the human race die out before I'd have sex with you.
Hypothetically, you're pretty, I'm cute. Together we could be pretty cute. What you say?
Ew.
Hypothetically,
No.
if I got in a car accident and like I breathed through my dick and like I was laying there on the ground like unconscious and you come up and like you had to resuscitate me and you were horny as fuck, would you blow me to like give me air? Hypothetically. Nah. Swings and he misses. My name's Chad, by the way.
That name's stupid.
Cold. It's kind of cold in here with that attitude.
Can you just go away?
Squeaky wheel gets the grease. I'm still squeaking.
I don't want you. I don't like you. I don't think you're funny. I don't think you're cool. I don't want to be a part of this. Can you just leave?
I'm a fashion photographer.
Go away!
I take my dreams. It's my passion.
You're gross.
My passion for like, you know, model photography.
You're not cute.
Low key, you could have had one of them. The baby. Medium key, you just being cold and you kind of jealous. High key, you hurt my feelings. Fuck you.
Subscribe to Charlie's, I like it. Subscribe, 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 Charlie's. Bye bye.
Let me at least get that Instagram doll.
Leave!
Leave? That means you want me to stay. Oh, right. I got bronchitis a little bit in my lungs. I also breathed in a piece of gum. It's like sitting in my lungs. Probably gonna die.